First, let me start with sharing my personal experience with Peter Carr, because of the conference nature. So actually, first time I met Peter Carr in 2006, and at that time I was a student at Northwestern University, and I was looking for summer internship, and I had interview with several banks and also with Bloomberg, where Peter worked at that time. And so when I met him, I think we had 30 minutes slot. I saw he printed out one of my papers on some barrier problems, how to solve barrier problems, and he asked some questions, and then he said, "Oh, we are also working on this topic," and I think he spent 30 minutes explaining his approach to solve the problem. Was one of the easiest but most pleasant interviews. And then later we met a few times at conferences. We also had dinner events, I think with you, Dilip, and I always was amazed, like sometimes in restaurant, when Peter starts thinking or explaining a problem, he always goes into details, and sometimes he would write on paper napkins to explain the problem, and it's really it was very great experience to know him, and also he what always struck me that his dedication to the subject and the way he was approaching people, the way he was trying to explain the problem, and also he was really focused, but he had very broad mindset. Obviously, I'm very honored to know him, and I'm also, well, given the circumstances, I'm pleased to be here and present my recent research and application of robust portfolio optimization. So today I wanted to talk about a new approach for estimation of covariance matrices for assets with different liquidity profile. What does it mean? So I work now for LGT. LGT is a private bank, and we run portfolios for wealthy clients, for family offices, and for typical portfolios include different assets. So for the most typical, obviously, it's public equities and bonds, right? That you have daily liquidity. You can invest through different ETFs, for example. Then you have hedge funds. Usually, still nowadays, most of hedge funds have monthly liquidity. It means if you can only invest in monthly basis, and finally private assets. Private assets being direct investments or fund of funds or secondaries, and there you have only quarterly liquidity. So the key problem when we want to run portfolio optimizer for such a broad area of assets, we need to estimate covariance matrix. And and we also propose what is called risk budgeting approach for strategic asset allocation. Strategic asset allocation in this context means that there are core asset groups, right? And instead of defining what is expected to return on private equity, we use a risk-based approach. And tactical asset allocation in this context means how we select instruments. If we say we want to allocate 20% to private equity, how do we select specific funds from the available universe? And this presentation is based on our joint work with Ivan Nossa and Nika Kassenholz from LGT. is accepted in journal portfolio management, and there's a short-lived arbitrage opportunity for you, because once we sign the commercial agreement, we need to remove it from SSRN, and meanwhile we can still access it by following this link. So let me start with the traditional approach to strategic and tactical asset allocations. So first step is a process known as capital market assumptions, where we forecast returns for core asset classes. Return forecasting means that it's a yield-based or valuation-based. There are several methodologies, and you can make a forecast. And then obviously we need covariance matrix. And once we have these inputs, it's a classic optimal Markowitz problem, right? That inverse covariance times the expected returns. Obviously, in our paper, but you can Google it. There's a lot of problems with this approach, right? That I'm not addressing in this talk, or I show you how to address it in a better way, right? And then obviously SAA and then TA is just implementation of this strategic asset allocation. What is important empirically, SAA decisions explain about 80-90% of realized performance. So that's why SAA is important, but also instrument selection is important. And this is how typically in industry, how people, when they speak of the investment universe, right? So here I'm using BlackRock CMAs. So CMAs are usually longer term predictions, right? You use some, say, either yield for bonds, for example, simple, always say bond with 5 years to maturity, yield of 5%, your expected return 5%, subject some assumptions. But and typically the results are plotted as say expected returns, and x-axis is volatility, and it's say standard theory tells us that the higher is standard volatility, the higher must be expected returns. And obviously say orange lines are what is called alternatives, right? Hedge funds, private equity, and empirically, CMAs are weak predictors of future returns. And usually when you run a SAA optimizer with CMAs, you will always overweight assets with higher relative returns, like private equity, private debt, hedge funds. We actually, there's a lot of some papers who analyze it. We actually working on another paper with ECOOP on how to empirically analyze it, right? It's also, of course, you hear many times that people talk, oh, this is not it's not working, or this and that, and we propose some realistic solutions if you want to follow this framework. And obviously, so there's one caveat here is why say if you go to BlackRock, right, and you talk to the why they like this approach, because as I mentioned, if you run this optimizer, your higher allocation goes to like hedge funds, even though picture is not realistic. Here you can see hedge funds have expected volatility 8% and expected return more than 8%, so Sharpe ratio 1, and there's very few hedge funds where you can invest and that have Sharpe ratio 1. So reason is that this is pure, in my opinion, marketing exercise, that you prefer to allocate, BlackRock prefers you to allocate it to private equity, which is managed by BlackRock. So this is how like in the end they sell you their funds, and they make money not by running this optimizer, but by allocating to their internal funds. So this is I hope there's no one from BlackRock here, but nevertheless, it's not specific to BlackRock. It's okay. So obviously, the next approach or the next line of thought is to use risk. So let's say we cannot use expected returns. Let's focus on risk. And say most well known is hierarchical risk parity proposed by Lopez de Prado. It's originally is proposed to stock portfolios, and I see that this, I believe it's a suitable method for like a stock portfolios. But why is not problematic for multi-asset universe? So first we have non-homogeneous volatilities that say maybe some fixed income funds, they have volatility 2-4%. You have public private equities, maybe it's like 20-25%. Non-stationary, so it's even if you can do clustering, the always question how I should allocate between clusters, right? Non-stationary correlations, correlations between equities and bonds changes, and therefore also is not clear how we should allocate risk between, say, bond and equity clusters. And the final one is how to select assets with long-term performance. The reason that, say, in our bank or in other places, the universe where you can allocate, it has maybe 1 or 200 or more hundred securities, and therefore you cannot just allocate or run this approach for all of them, because some may be like regional equities, or you always question do these assets have a long-term potential. With stocks portfolios, usually it's always these portfolios come from some sort of sort. So it's there's some alpha characteristic between your selection, and then this method can do risk allocation. So nevertheless, risk-based like using factorization and sparsity are statistically robust. And what so before presenting our approach, it's a broad way of say how we come up to this framework or how we justify. And there's so interesting, like say, developments is adaptive market hypothesis by Andrew Law. He wrote several papers, and there's a book. But what he's saying that non-stationarity is inherent, that prices reflect given economic conditions and given positioning. So there are always, and those are changes in time. But nevertheless, he's saying that he still reconciles those behavioral biases that you can exploit momentum low beta. So say what it means. Non-stationarity means we cannot forecast expected returns reliably. Nevertheless, behavioral biases are around, like momentum, low beta, and everything. And also was good, let's say, observation by Bernstein is early 2000 already that long-term assumptions about future are doubtful, right? And policy portfolios must be respect short-term developments. So therefore, we need to mix. Say, I want to have a long-term exposure, maybe just driven by risk, but I need still implement some tactical signals to guide my portfolio through, like say, current market conditions. So our adaptive approach. So we first, I show you examples after that. First, I wanted to present a little bit with say methodology, and then we go through examples. But so core asset classes: public equities, bonds, private market, hedge funds. Right? So 5-6 asset classes. We run. We can select representative indices. We run risk-based allocation. We get our benchmark portfolio. And then, of course, we can use this benchmark portfolio. And benchmark portfolio, say, long term, it only takes risk into account. How, say, over past year or two or three, how equity is correlated to bonds, right? This is without any return assumption. This would dictate our strategic asset allocation. Tactical asset allocation then is implementation portfolio. And here we use alpha characteristics. So here we have specific funds or stocks. And what is interesting that the same, everyone knows about momentum through different asset classes, right? On instrument level, but it also works on fund level, right? If you say you have equity universe with sectoral, with regional indices, you can do the same, and it works. And the final piece is obviously we need factor-based covariance matrix. That if we have a universe of several hundred securities, the only way to say robust measure the risk of this is having a low factor model. Low dimensional factor model. And also, like this typical, so you probably, if you use Bloomberg, you know there's a Barra factor model, the Bloomberg factor model. Usually, in my experience, or my intuition, that for purpose of multi-asset portfolios, they are not really well adapted. The reason is that there are too many factors. It's always like 1 or 200 is too much, right? You want something that is visible, right? And therefore, and we want also like that factors are represent risk premium source. And therefore, we selected 6 risk factors that is equity, bond, credit. For credit, we can use CDX, IG, and high yield. So these are really excess credit premium. Private equity, that I will explain you. This is, I think it's the first time that I see something like that, but private equity premium that can be obtained through liquid futures. Then carry, that we just use FX, and for inflation we use break-even swaps. And these factors can be, we create like a portfolios that implements these factors using either futures or QIS trackers. Like nowadays, all banks, all major investment banks, they can do you say rolling strategy and break-even swaps. So you can have exposure to inflation risk. Without any extra, let's say, exposures. You don't need to buy treasury or inflation protected tips to get exposure to inflation. And also what is important for portfolio, we can obviously monitor the portfolio exposures, and we can hedge unnecessary risks. And here I just show, like, say, performance, historical performance of these risk factors. So these are all excess returns. So you can see like a Sharpe ratio. So for equities is 0.3, and then all assets. So it's quite good. It tells you there are many studies actually that your say expected long-term risk premium should be of the different assets should be 0.3, like in Sharpe, when you measure Sharpe ratio. And also here we have this, our factors are variance stationary, right? That more or less long-term out of samples. So we obviously, when we do volatility targeting, is ex ante, but exposure we also get something like that. And obviously, what is interesting, you see how factors obviously correlation changes, right? For us, if we get, we can say decompose portfolio exposure to factors, and then obviously at different cycles we have different factor, like they can be good or bad. So for example, 2008 equity did very bad, bonds did very well, right? For example, 2022, actually bonds did worse than equities. What only work is inflation premium, especially in 20 and 21. So this gives you like a kind of intuitive way understanding your exposures. And right now, if we look, say, long-term correlation matrices with shorter term, we see that currently there's actually nothing can diversify equity risk, right? Prior, say, over certain periods, bonds can diversify equity risk, nothing else can diversify. And obviously, like even though, say, credit, private equity premium, carry premium, inflation premium, they standalone sources, but they're obviously correlated with equity risk. And therefore, this type of factor analysis provides us robust estimation of portfolio risk. So I wanted to talk specifically of private equity to show you how we model it. The reason that private client, wealthy individuals and family offices, they prefer to get exposure to private equity, private debt. The reason that long term these assets provide access, say, relatively high returns without taking on leverage. And we model factor risk premium, what we call, we can always think that this is private equity is exposure to growth, to small caps, and to credit carrier. And we can construct this factor risk premium like having futures exposure to corresponding futures, and we neutralize by short exposure to S&P index. So this gives you like what we call private equity factor risk premium. Before we continue to look at actual returns, there's it's a well-documented bias in private equity for private equity funds that it's a reporting that they tend to smooth out the performance, right? And when we actually just as simple when we say use a roll forward estimation of IR1 beta phi, we see that on average the beta is almost 0.5, 0.6, right? So there's very statistical tendency of these funds to smooth out the returns. When we do the risk, we should kind of unsmooth it. So once we estimate this beta, we can estimate also epsilon, right? And here you can see, so the blue line is the reported performance of MSCI private equity index. The green line is unsmooth. So the volatility drop, like, and on the right figure you see the beta. So average beta of reported is 0.4, and actually when you unsmooth it, it has beta of 1. So these are obvious risks when you model private equity or funds with very low liquidity. You should do unsmoothing, right? Otherwise, it will be too like unrealistic, the risk profile, especially if you look at drawdowns. Obviously, when we compute performance, we use reported returns, but say come 2022, and you see that, okay, they report that minus 20% drop. If you want actually to sell that fund in that time, your realized, say, return would be maybe minus 30, minus 40%. So why it is important to do this unsmoothing? And we always, so whenever we do risk calculations, we always unsmooth. And here I wanted to, so now we have, and if effectively beta 1. So as I showed you before, beta is 1. So actually, what I call private equity x equity. So when we just take the performance of this private equity index and subtract the performance of MSCI equities index, and you see that actually we are very close. What you see in blue line, if it would be really you invest in the private equity index and you short MSCI World, this is what you get. And this green line is what we get with our futures, like futures factor premium. And we see that we have beta of almost 1, so we fully can capture. And also over time, effectively, everything, all excess performance can be attributed to our PE risk factor. Residual very small, especially for last 10 years. Obviously, before there could be some cross-sectional differences, but so we believe it's a right way to approach the risk premium factor for private equities. And and before, okay, so say now we are smooth, we have, so classic covariance matrices, you probably know that in sample or shrinkage are well suited again for the reason that the optimal frequency, right? If you have funds where you have different, say, return streams, you need to extrapolate. You need to something to do. Target covariance also for shrinkage. For multi-assets, for equities, it's easy because it's 1, right? The long-term, say, correlation, it's a good assumption. You assume 1, but for equities, bonds, it's not clear. Then again, industry models, again, how you extrapolate. If you want to apply them in practice, you need to do extrapolation. And also, given that they have many factors, how, if you want to estimate a factor model, how do you do it? Like, what's your best approach? So here I start presenting our model. We take equation 1. Right? So it's a classic factor model where X is some set of your factors, Y is asset returns. What we do split. So equation 1, for different funds, we estimate different betas. So we have set of, say, assets. Based on their available liquidity, we estimate betas. And we use extrapolation of, say, beta loadings and residual loads. How we estimate betas, right? Because, again, so we do, as I said, I really, typically people do this asset class selection. The problem is always subjective, right? Some say high yield, it's half equities, half bonds. What cluster, what group should we put it in? So obviously the best is just we do statistical. And we statistical, we have a set of assets with monthly liquidity. We apply a clustering, and that splits, creates some groups. And what is sparsity? So you know the traditional, and obviously we want to introduce sparsity. Traditional methods are usually, like, say, pure loss, right? Usually the relationship within clusters is not clear, right? That there's nothing that forces all, say, equities to have the same significant betas to the same factor, right? That with loss, and I show you example. So what we propose is to run, so we first apply statistical clustering to select clusters of within the asset group. Then we run this regularization, and we also use this EVMA weights. I'm in a class that I kind of believe that all models should have some Bayesian updates, and EVMA is a simple way. You always think, okay, what do I trust? I trust developments over last year or over last 10 years, or with something that happened 10 years ago. For me, I wait on something that happened over the last year. And obviously then, okay, we now have this factor model. We estimated betas. Obviously factors are daily. Factors we can observe daily, that these are liquid. And we see, and we model it using also EVMA covariance. That's the simplest one. And obviously they're more or less, say, they have the same volatility by construction. So it's really And correlation you see changes, right? Between the most striking is between equities and bonds, right? Like in 2000 post the COVID, bonds was good diversifier, but not anymore these days, right? And then also you see that like how carry premium and inflation premium, they're a bit less exposure to these factors can provide you good diversification. And here I wanted to show you example of our clustering approach, right? So here I have some asset universe where in the top subplot you see assets with quarterly liquidity. And this is a classic word clustering method, right? Where we just use within each group, we use say quarterly returns, we estimate correlations, we do clustering, and we say for quarterly universe, we see there's a distinct cluster of macro hedge funds, insurance-linked securities, and the rest of private assets and some hedge funds. So this defines our clusters. And then when we estimate betas, I show you how these clusters enter the picture. So here I use this.
Your quarterly returns are non-overlapping quarters?
Non-overlapping, yes.
No.
Yes. And we use EVMA weights. So obviously, if you say data usually starts from 2000 for this type of funds, so by this date we have 100 observations that we kind of weight. So here, so we, as I said, now we say we have time series of our factors and time series of these assets, right? And when we use, say, classical, without regularization, the multivariate regression, so always it has too many signs, right? It can explain you, say, in sample, you have exposure to all the factors, right? When you use lasso, like sometimes you see the gaps, right? It's what we want to see is some regularization. But then within the clusters, like say, clusters of they may have different exposures, right? For example, all hedge funds have some exposure to bonds, but not hedge funds with relative value. It's always questionable. So why, when we do this regularized clustering, whenever one factor is important for the group, right, it will be important for all of them. So that's and it's a good way to look in the clustering. And finally, then once we have the factor model, our asset covariance matrix is just a classic formula that links factor covariances to instrument betas and idiosyncratic variances. And here we just need to proper account for annualization factor. And the final output is that we have, so here assets, say, our global universe with funds with different liquidity, but in the end we have, when we run optimizer, we can have one covariance matrix for all, and this is not forward looking, right? When we say we always use last betas and last observed, last estimated betas and residual variances. So now once we have it, we can run some our optimizers. So the first, as I mentioned, for strategic asset allocation, we do this risk budgeting, right? And risk budgeting starts, okay, we have some portfolio weights, we have estimated covariance matrix, sigma, and we compute the risk contribution. And risk budgeting problem is solved that we also have some budgets, we come up with budgets, and we run this risk budgeted problem. Usually in practice, we add constraints of type 6, right? That we want to, say limit exposure to equities or sandwich exposure, so to bonds. And this is also, it's not mathematical, so say it's easy to write these equations, but numerically it's not, it's a hard problem. And there's a paper by Richard Troncalli that is very nice. They propose a stable way to solve this problem. The classic risk parity, you only preserve this weight, right? If you want to add individual constraints for securities and group-based constraints, then you need, I advise you to look into this paper. And now, as I mentioned, so now say we have SAA, right? And now we want to kind of introduce for instrument selection where we want to assign some alpha characteristics. And the classic alpha characteristics are risk-adjusted momentum, classic one, and low beta, beta to static weight benchmark. Or for each instrument, you can define the beta and run it beta. And we normalize. So obviously this should be normalized using group means and deviations. Here we differentiate. So for me, beta type is always something like close to passive. It's regional indices, style indices, like value, like say within equities, you have also different styles, right? Within fixed income, you have high yield, emerging market bonds, or local currency bonds, so on. And for alpha type instruments, it's really hedge funds, right? The ones that really do not have their benchmark is effectively risk-free rate. And here we use this like alpha, which is Jensen alpha. So we have beta exposures, and we look at excess performance, and this is our like alpha. And in the end, when we look at alphas, when we normalize, it's really like a z-score, right? It's from -3 to 3, say on average, right? And obviously they change, right? For example, at certain point, treasuries that they had good alpha characteristics, but not anymore, and so on. And these are inputs. These are our alphas. And when we solve, when we finally solve implementation portfolio, we want to maximize exposure to these alphas, but we also want to keep a tracking error. Like those weights SAE are coming from our risk budgeted optimization. And here we split by groups. So we say within bonds universe, we have tracking error. Within equities universe, we have tracking error. The reason that it's for multi-asset portfolios, sometimes correlation effect may cause you, say, overweight, say, most of your tracking error may come from, say, equities, right? When, say, you have exposure to bonds and the correlation is negative, you like sometimes diversification effects can affect your tracking error, right? Which we want to avoid, and why we found that when we split by groups is more stable, the portfolios are more stable. Also turnover constrained by different groups, because here we inherently we deal with illiquid assets, right? And there we must do some grouping. For say for public equities, we can allow maybe 100, 200 annual turnover. We cannot do this turnover for hedge funds, right? So therefore, to do this kind of practically implementable, we need to do this turnover constraints, and also some sub-asset range constraints. Maybe overall you don't want to have too much exposure to emerging market stocks. So this we can implement this type of problem. And finally, I think I have a few minutes. Just wanted to present you some illustrations of our approach using the universe that we have in paper. So usually when you speak, say when you the client and you come to LGT or some other bank, they like portfolio managers, advisors, they will design what is your say strategic asset allocation, and say you have like a target weight, maybe depends on the mandate. So we have here target 35 to equities, 50 to alternatives. We have different ranges, how these allocations can vary. Then we have like usually SAA is done for these sub-asset classes. So you have like usual suspects like raise credit, high yield credit, equities as a line item, hedge funds, private equity, private debt, real assets, and so on. And usually also you specify some weights. And usually you have always indices that you model the risk of these assets. If you want to show, say, what would be expected performance. And usually, again, here I just wanted to show the performance of these level 1 assets. Usually you always, like, yes, this, that I always doubt that volatility is proper measure of risk. And over time, you actually see that it's not really much, right? That say private equity, if you adjust for risk, well, kind of excess performance was good, but going forward, and also betas, obviously. Well, and the next step. So usually, always the question arises: how do you determine the risk budgets for such a portfolio? Well, it's a little bit like a look back exercise, right? You need to, the way we do it, right? Say, we always know, say, what would be ideal allocation, right? Like, say, what would be my weights, like long-term weights that I want to this mandate. Then I kind of vary risk budgets before I arrive to these weights. That's not obviously in some like a classic risk parity approach where they say, okay, we have maybe 4 asset classes, like equities, bonds, alternatives, and commodities, and we want to kind of impose risk budgets. It's always difficult, like say, less clear way to come up with risk budgets. But we can always do some sort of iterative. We run this portfolio with different risk budgets. We see what were the weights, and then in this way we can fix these risk budgets. So it's a little bit of inverse problem. And what I wanted here to show, obviously we can see the risk post-risk contributions. So obviously for balanced mandate, as I said, target weight of equities is 35%. Nevertheless, risk budget of equities is 70%. All portfolios are dominated by equities risk. So here we see the same. It has contribution of 70%, even though average weight is 30%. As here, I think, 35%. So in the end, we kind of doing this exercise, we can match, say, on average, what would be the weight. The most interesting figure you can see is that rates, actually, this SAA method, right, it's not taken into account expected returns. And nevertheless, prior to 2001, it has always the highest allocation to bonds. Why? Because bonds were very good risk diversifiers exposed, right? It was always, like, most of the time negative. When the correlation changed and rates bonds become positively correlated to equities, actually SAA dropped drastically, right? And this is and it's done without any, like, say, return assumptions. It's why we like this risk-based approach that gives us a strategic asset allocation. And here, obviously, we also, for paper, we have a universe of some indices that we would implement. So, for example, for equities, typically, of course, we have MSCI. We would do regional equities. Is what people usually do in practice, right? You do some regional implementations. The same for bonds. usually when we run in practice, we have actual funds that we can allocate. And then universe maybe here could be like 100, 200 instruments. And also, so as I said, we specify what is it a beta or alpha? For all hedge funds, it's alpha types of instrument. We specify the turnover group and also rebalancing, when we can rebalance. So this information, then we can construct our portfolios. And for these portfolios, I just use a static benchmark. So within asset class, we use equal weights, right? It's the most classic one. So what we see, benchmark, our SAA kind of outperforms slightly the static benchmark. We all know that it's hard to beat equal weight allocation, right? Still, we have lower drawdown for strategic asset allocation, right? But nevertheless, for TAA, this is our optimizer. It produces good its excess performance more than 1% annually. And bear in mind, this is like, say, universe of indices. When you do actual funds, you can get much better results. And also the reduction in risk. And what is most interesting for me is a Princeton style allocation, right? In the end, when we do TAA exercise, so as I said, as you see that SAA is very hard to say deviated from equal weight benchmark. So we can always say the value added is better steering of, say, equities versus bonds or commodities versus bonds, that it picks up some risk cycles where it provides you better allocation. Whereas what we want from instrument selection, really, and when we run like, say, our optimization with alphas, what we want is really instrument selection. And this is what we see. Effectively, the way how can we outperform our equal weight benchmark or our static asset allocation, we do best instrument selection. And what we show that, say, our alphas, they can generate this picture, right? Which I like very much. And here I just show you simple, obviously we have tracking error by different groups. Usually when portfolio managers, they talk for them, the risk is always when portfolio underperforms your benchmark, right? This is the highest risk. That then there is reputation, clients are not happy. So why we really need to well constrain your SAA. Right. In some sense, we as a quant and PM, we will be Dutch based excess performance we generate over the benchmark, static allocation benchmark, right? Then of course we have turnover, and here is nothing to be afraid. Say, to have high turnover for liquid asset classes, it's fine, right? Obviously for less liquid stuff we need to constrain, right? That's why. And also when we do implementations, we have our we have this kind of actions, whether we cannot do anything for this fund, we can only buy, we can only sell. So wherein this like liquidity constraints, we can manage the portfolio. And also what is most interesting, then of course we have a factor model and we can do like betas, right? That betas of portfolio into different style factors, right? And obviously equity is the biggest risk. For this balanced portfolio, equity beta is 0.4, right? Across all instruments have some small exposure to equity beta, right? More recently, we have more exposure to bonds for this portfolio, right? So it's always it's good to look and see how I'm positioned in terms of betas, and you think here could be like 200 instruments behind it, and you just decompose the risk of this portfolio into some set of factors. Private equity premium, right? I have an exposure, and you see actually when we do performance attribution, right? We obviously say our total arithmetic return is 170%. 1/3 of it comes from equities. Another 1/3 is alpha. Alpha here is something that's not explained by factors, so it could be our timing, it could be some other bets that we have. And nevertheless, the rest is equally spread between like private equity, carry, inflation. So annually we get around 1% by exposure to these factors. And obviously the most also interesting is the risk. How is my portfolio risk can be decomposed as these factors, right? So we see prior to 2021, we had a lot of equity risk, then it more recently in drop, we have more actually risk to bonds, right? Because we still need to keep some allocations to bonds, and bonds are actually now, they're almost like a risk driver as equities. We have credit, private equity, and this is good way to steer the portfolio and avoid unintended bias. I also for you, obviously this is Lassa methods. It's quite there's you need to do a few exercises to implement it. I have a template implementation in my GitHub. You can find just for you to start running to get this. So usually we need to have like a rolling covariances, right? To run our like rolling optimization. So there are some, if you're interested to start looking at it, you can find some Python implementation there. So in that, I wanted to conclude my talk. So we have 5 minutes for questions if you have. So what we presented is a new hierarchical clustering group Lassa that I think is the goal when we want to estimate covariances. Our belief is that we need to regularize using a factor method and do it as sparse. Right? Then also we don't need expected returns. It's why I adhere to and reload this adaptive hypothesis that we cannot predict expected returns, right? And then we do risk-based SAA, strategic asset allocation, where we only look at risk. And for tactical, for implementation portfolio, we look at alpha characteristics. And then we have sub-tracking error to SAA. And then we have risk-based as a byproduct of our analysis. We also see portfolio factor exposures into factors that you can hedge actually some of the factors because they're all tradable. And so thank you with that. Thank you very much for attention and any questions if you have.
Yeah, just curious that you have only about 80 observations in non-overlapping quarterly data. And I was wondering whether you might consider allowing some degree of overlapping to get richer, more observations, then use your techniques of smoothing to try and remove the autocorrelations that might arise from the overlapping.
Okay, that's a good point. So when we
and when you do your unsmoothing, you probably could go second order as well, not restrict to first order, and maybe even look at vector autoregression rather than univariate.
That's good. That's a good point. I look actually. So some papers they recommended second order. The reason it was a bit too noisy. As you said, we have limited observations, and most of the you need to have kind of a window, right? With hindsight, obviously, we can say, okay, I have some initial values and I use them. Why I do this EVMR? Because when we run backtests, we won't say use information prior to it for everything, right? That including this. And yes, this is valuable. It could be exported. That we say increase the number of observations and do some adjustment for autocorrelation. You mean for smoothing and also for betas?
Well, for because you know that once you allow overlapping, you've already built some sort of correlation, which is the same thing that's happening when you're doing your unsmoothing, the same technology. And so I'm just saying that you can, use that technology to unwind the overlapping feature and thereby, get a richer assessment of possible correlations and for the betas as well. Yeah.
Good point. Okay.
Another question. So what do you do for, say, Swiss francs denominated portfolios? I think then this dollar-based multi-asset rotation is difficult, right? So you have this substantial negative dollar drift.
Yes, that brings to another talk for next year.
Yeah.
How to hedge equity risk, and this is a very valid question. Usually, still the set of investable assets, especially in private equity, is USD dollar. And yes, as a Swiss investor, if you want to say invest in the US based or global assets, how do you do this dollar hedging? Our view is it's that you run this SAE portfolio, and then if for a Swiss client you do so, you need to bring some currency hedging right into your account. But that it's a very good topic for next year.
Okay. Okay.
I have a curiosity. When you do the clustering, what kind of distance have you used? Is the dendrogram robust to changes in the distances?
And then when we do this clustering, it's intercorrelation distances, yes, in what. So this numerical values are intercorrelation distances.
You are not trying other distances to see the robustness of the grouping?
No. Usually, in different settings, I experimented it. Was not much difference. Okay. But this is also valid point. I will consider it. I played around with a little bit with thresholds. As you know, there's different ways to specify the breakdown thresholds. There is actually a recent paper from the last guy, Chibushini, about this problem. So yeah.
Thank you.
When you do the unsmoothing process for the private equities, do you also look at the impact on the correlation structures?
Yes.
Because I mean, from my experience, the unsmoothing process rely on the assumptions that the autoregressive coefficient is a constant, right? And sometimes it introduce the model risk and introduce the noise in the correlation structures of the unsmooth time series.
Well, so if I understand you correctly, so these betas should be rolling, right? Because they change, and usually we cannot, when we do backtests, we cannot just use in-sample data because it's cheating, right? It's probably not good say confidence in your model. So yeah, we vary these betas based on how it evolves. I suspect there was something how they report this data. There was drop. Also, if we look at new waste volatilities, I don't know exactly. They changed maybe methodology why we see this drop. But then when we are smooth, it's really the impact. If this is exactly what you want in portfolio, that you don't want to say private equity beta of 0.5 or 0.4 that as reported. You actually know that the risk is 1. This beta is 1. Equity beta is 1. and the same for volatilities. And obviously on smoothing, it creates this effect.